morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, financial results continue to roll in, and we at Bourse continue to make some sense of what is being posted by the various companies listed on the Trinidad and Tobago Stock Exchange for you, our investors, in the local equity markets. Today, we're taking a look at Grace Kennedy Corporation, or Grace Kennedy Limited rather, as well as Agostini Limited. Both groups would have had different fortunes for their respective 6-month and 9-month fiscal periods during 2024. Let's take a look at what would have occurred and what investors might expect in the coming months ahead for both of these groups who pursue both organic as well as acquisitive growth as in terms of improving their financial performance. So turning firstly to Grace Kennedy Limited, the group would have reported an earnings per share figure of 19 cents TT dollar equivalent, which was a 6.2% increase from the 18 cents recorded in that prior comparable period of fiscal half year 2023. Revenues for the group were up just around 7.5% from 3.28 billion to 3.53 billion TT dollar equivalent. Revenue from products and services rather. Overall revenues up 7.9% from 3.4 to just about 3.67 billion. Expenses up just around 8.2%. Ultimately, net profit attributable to equity holders of the parent would have increased just around 5.8% from 183 odd million TT equivalent to just around 193 odd million. When we take a look at GKC's profit before tax composition by segment, we do note some fairly significant changes. Food trading continues to be the dominant generator for the group in terms of profit before taxes, and that was up just around 10 odd percent from 172 million in that half year of 2023 TT dollar equivalent to 189 million. This was partially offset by a decline of around 11 million in its money services segment, down around, again, 11% from 72 million TT equivalent to just about 64 million. Banking and investments up around 52 odd percent from 17 to 26 million TT equivalent in that green segment, and insurance as well on the heels of some acquisition activities, also improving from 32 to 42 million TT dollar equivalent in terms of contribution to profit before tax. A roughly 51% increase. So generally, the trend for GKC over the past few comparable periods in fact, has been upward trending, which is good for investors. But most of that is being driven in the main by a fairly significant expansion in their food trading segment, as we can see in that very large blue column of section of the overall profitability before tax. From a margin perspective, GKC in an inflationary environment with inflation starting to abate, based on some preliminary numbers, suggest that they have been doing a reasonably good job at maintaining margins with both operating profit and profit before tax margins in that reddish and bluish color remaining relatively stable compared to that half-year period. Operating profit margin, for example, was 7.8% in the half year of 2023, and it stayed at roughly 7.65% at that half-year mark of 2024, with PBT margin also 7.85 and 7.65%, respectively. So certainly some degree of margin stability for Grace Kennedy in over the past two recent comparable periods. Now, when we take a look at the stock price, GKC is trading at a price of $3.61, which puts it at a price-earnings ratio of 10.4 times, which is below the sector average, notably so of around 13.5 times, and does offer investors a dividend yield of 2.7%, below the sector average of 3.3%, but importantly, GKC does pay its dividends in US dollar equivalent. So with considering earnings growth, or continued earnings growth rather, those stable margins and relatively attractive valuations, as well as that dividend in USD, Bourse is maintaining its overweight rating on GKC for the time being. Turning very quickly to Agostini Limited. Well, for their 9-month fiscal period ended June 2024, the group would have reported an earnings per share figure of, on an adjusted basis, of $2.56 compared to the $2.63 adjusted in the prior comparable period. And that adjustment really was for a one-off gain, which would have inflated earnings results in the prior comparable period, but nonetheless still a 2.7% decline in that adjusted EPS figure. On the positive side, revenues were up around 7.7% from 3.55 billion to 3.8 billion. Operating profits up just about 2.8% as well, from 375 million to just about 386 million. The real driver in terms of that adjusted decline in earnings would have been a fairly significant increase in finance costs of around 38%, from 33.2 million to 46 million. ultimately net profit attributable to equity holders dipping to $176.7 million. When we take a look at the profit before tax by segment analysis of Agostini's, we can see that there was pretty much treading off water, as it were, in terms of PBT generation. Pharma and healthcare fairly consistent at around that $149 million profit before tax generated across both 9 months 2023 and 2024. Just around a 1.2% decrease in that consumer products PBT from 176 to 174 million in that yellow segment. And of course, in the absence of that significant one-off gain, energy and industrial and holdings, energy and industrial and holding segment fell from 137 to 17 million. However, compared to prior comparable periods, excluding that one-off gain, fairly consistent in terms of the performance of this particular segment. From a margin perspective, there was, in terms of PBT, a decrease in margins, of course, from falling from 13% in that prior comparable period to 8.9%. Of course, these margins take into account that particular one-off gain, in particular in that PBT calculation. But when we take a look at operating profit margins in that purple segment, which excludes that one-off gain, it fell just marginally from 10.6% to 10.1%. Again, in an inflationary environment, reasonably good performance from our operating stability perspective for Agostini Limited. So at a price of $68, well, the group trades, or the AGL trades, at a price earnings ratio of 20.2 times, above the sector average of 16.2 times, with a dividend yield of 2.2%, which is below the sector average of 3.5% for the time being. So with revenue growth in mind and continued acquisition activity, but watching those elevated valuations, Bourse is going to maintain its market weight rating on Agostini for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse. Email us at invest@boursefinancial.com. And of course, you can check out our website, bourseinvestment.com, where all of our research is absolutely free. And you can catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. So until next time, stay safe, happy investing, and we'll see you again on the Bourse Report.